Hi, I'm John Pruitt. I'm a partner in Sutherland's New York office in the Insurance Practice Group.
And I'm Darren Morera, an associate in Sutherland's New York office.
We're going to speak briefly about reinsurance collateral reform, an issue that's preoccupied for many years policymakers in the insurance industry is the need to change the rules that require unauthorized reinsurers to post collateral to secure their obligations to U.S. domestic ceding insurers in order for ceding insurers to take financial statement credit. Historically, credit for reinsurance has been granted only for reinsurance ceded to licensed reinsurers, accredited reinsurers, U.S. reinsurers domiciled in a state with substantially similar standards for credit for reinsurance as the ceding company, or other reinsurers that post collateral equal to 100% of their obligations.
Recognizing that the insurance business is global and that there's no sense in a system that requires the most secure, well-capitalized reinsurers to post full collateral, states have begun reforming their credit for reinsurance rules to permit reduced collateral. Florida and New York were the first. And in 2011, the NAIC adopted amendments to its credit for reinsurance model law and regulations. These reforms happened around the same time as Dodd Frank, which provides that a ceding insurer's state of domicile will have exclusive authority to grant credit for reinsurance.
The new measures recognize a new class of reinsurer called a certified reinsurer. A certified reinsurer must be approved in each state separately, that is, each state of the ceding company, and it must meet certain specified requirements. The most important are that it must maintain capital and surplus of $250 million. It also must be licensed and domiciled in a jurisdiction that has been determined by the insurance regulator in the ceding state of domicile to be a qualified jurisdiction. The amount of collateral that a certified reinsurer is required to provide in order for the ceding company to take full financial statement credit for the reinsurance is based on the reinsurer's rating as determined by the ceding insurer's state insurance department. The state insurance departments will consider a variety of factors, including the reinsurer's financial strength rating as given to it by credit rating agencies. For example, the highest rated and strongest reinsurers, those that are rated AAA, would have to provide no collateral. The next level, reinsurers rated AA or better, would have to provide collateral equal to 10% of their obligations. The next level, single A, would have to provide collateral equal to 20%, and so on.
Outside of Florida and New York, this is very new. States are just now amending their laws and beginning to accept applications for certified reinsurers. The NAIC is developing a process for maintaining a list of qualified jurisdictions that states will need to consider when determining whether or not a jurisdiction is qualified. In addition, the NAIC's Reinsurance Financial Analysis Working Group is tasked with helping states review certified reinsurer applications.
The NAIC accreditation standards for states to become an accredited state insurance department will recognize the new revised NAIC model laws as meeting their standards, though it's not required. It's a very dynamic area. As things stand at the beginning of May 2013, the states that have adopted reinsurance collateral reform measures represent approximately 50% of the total U.S. domestic insurance premium. Many other states are considering legislation, and it's certain that more states will enact reinsurance collateral reduction reform. Certified reinsurers have been approved to date in Connecticut, Florida, and New York. As I said, it's a very dynamic area, and we expect the landscape will look very different in not very long. Thank you. I'm John Pruitt.
I'm Darren Morera.